If we're not in one right now, and we are, then we're going in one. Did you know that we've had approximately 48 recessions in the United States of America? Get ready. Hello and welcome to the Durham Talents channel. My name is Jesse Durham. For today's topic of discussion, we're going to talk about how to recession-proof yourself with infinite banking. Now, if we are to give a definition and not move that goalpost of what a recession is, one is going to be that it's simply 2 quarters, so 6 months of a downward trending GDP. Now, we've had approximately 48 recessions, depending on who you've asked, here in the United States. Now, be that as it may, again, if there's some squabbling about what that exact number is, let me just point out it's not rare. It has happened many times. And if things are going to remain the same, insert government, the Federal Reserve System, conventional money, philosophy, what we can count on is that this boom-bust cycle is going to continue. There's going to be a boom, there's going to be a bust. And just to quickly name a few, perhaps we could talk about the dot-com bubble around 2000. We could talk about the housing crisis in 2008 that, again, some would call the Great Recession. So we've had many recessions. We're probably going to have many more, again, with certain things being as they are, without us moving towards any kind of a gold standard, let's say, or some sound money solutions. There's going to be this repetitive cycle of boom and bust, and we need to recognize that, and the sooner that we do, the better off we're going to be. I believe that studying history can help us to understand what's happening now and what we can anticipate in the future. And I would highly encourage everyone listening to read subjects like, of course, Becoming Your Own Banker by R. Nelson Nash, his second book, Building Your Warehouse of Wealth, another book that he co-authored with Carlos Lara and Bob Murphy, How Privatized Banking Really Works. And then in all of those books, there are many other recommended readings. I cannot begin to name them all, but if you start there and if you look at those recommended readings, you're going to be well on your way, to be sure. Now let's talk about some of the actors that I would say are in this play of life that lead to these recessions. Let's begin by talking firstly about money. The dollar itself here in the United States now, it's not tied to a gold standard like it has been before. It is a fiat currency. It's literally digits on screens or paper money that is printed at whose control? Well, not mine and yours. And we're going to get to that. We're going to get to the practical things, again, that you and I can do to recession-proof ourselves as best as possible. But money is a key actor in our lives. There's no question about it. It's a depreciating dollar, it would seem, meaning that it's less powerful. So a good way to test that is to ask, well, how much would a candy bar cost today versus 5 years ago versus 50 years ago, what it might cost in the future? That's just a good way to look at money. Look at the dollar. It's a depreciating fiat currency. Now, it is still the world's leading currency. It is the world's currency right now. So I'm not trying to downplay the power of that medium of exchange. There's not a better one. There's not one that's, more readily used, of course, or recognized, of course, here or internationally for that matter. And banks are going to be the next character that, well, they are that reservoir. I mean, just think, we're told to conventionally deposit our dollars where? I mean, they just automatically direct deposit somewhere. Well, that somewhere is someone's property. Someone owns those conventional banks, and every dollar that we deposit into those banks are lent out in multiples. So not only are we talking about a fiat currency that's a depreciating dollar, but what's a big part of what's causing this issue? Well, many. The currency itself being printed, again, I've pointed out, we're not in control of that. Someone else is. And side note, interesting study about the Federal Reserve, for example. The Federal Reserve It's neither a federal entity like you would think, government entity, nor does it have reserves. So, interesting side note, again, with the recommended reading, you can find out lots of interesting things there. But for sure, the printing of dollars or digits contributes to the issue. And then also, for sure, banks lending out multiples of the deposits that we're making. So, quantitative easing, fractional reserve banking. This is what I'm talking about. They're literally printing up money out of thin air. Notes on cars or homes or what have you, our mortgages, our car payments, that money did not even exist prior to us signing that note. Think about that. We're making our deposits in somebody else's business. They're leveraging it. When we finance with that entity, the conventional banking system, we're signing notes that creates money that didn't exist prior to that. Let's keep going. The Fed, I've already mentioned. The government, there's so many things there. That will probably be its own subject. And of course, eventually I'm going to say that we arrive at mutual life insurance companies being big actors. Why big actors? Well, because life insurance predates our tax code, for example, here in the U.S. 1913 tax code begins. Mutual life insurance companies had already existed for many, many, many years. So here we have 100 plus year old life insurance companies, mutual life insurance companies, who have been meeting every single contractual obligation in paying out death benefits, providing what we're going to be talking about here more, the living benefits to policy owners with those companies. Because a guaranteed death benefit, that's fantastic. It's a tax-free transfer of wealth. Beautiful thing. But it also has a net present day value, of course, because that's a guaranteed future windfall of tax-free money to our beneficiaries. But it has today a value as well. And that's why whole life insurance has cash value. Now, in considering these actors and these characters in this play, of course, you are perhaps one of the biggest. So perhaps I even should have started there. See, Nash in his book, Becoming Your Own Banker, he addresses the human problems. See, it doesn't matter if the economy's rolling along great, government's doing what government should be doing, banks were being honest. They can't. But if they were, right, if all these other actors were doing their part, and yet we still did not confront Parkinson's law, Willie Sutton's law, the golden rule, use it or lose it, all these other human issues. See, if you spend more than you make, nobody else can influence your ability to recession-proof more than you, is what I'm trying to point out here. Everything else could be right on track, but if we're not addressing Parkinson's and Willie Sutton, etc., then we're setting ourselves up with less layers of protection against risk from recession. And again, it's going to happen. It is happening right now, actually, literally at the time of this recording in 2020, but it will happen again. It's happened before. It'll happen again. So I don't want to bypass, and actually we're just going to deep dive. In bringing banking back to the me and you level, in implementing the idea of becoming your own banker, we need to start with thinking long range first. Okay, so let's start with one of Nash's key principles, which was think long range. Think and implement concepts where you can act intergenerationally. So not just long range in your own life, but can you begin to think about children, children's children, and on down the line? Thinking long range, the longer range you can think, and just, again, if you consider what the masses are doing, instant gratification. If we're doing the opposite of that, we're just probably going to do pretty good. Whatever the masses are doing, if we do the opposite, I'm just saying this, it's a wild idea, right? That you could do well for yourself by just simply doing what is opposite of what the masses are doing. Certainly most are thinking short range. They're thinking about this Friday night. They're thinking about today. And there's nothing wrong with addressing things right in the here and now. However, the longer range we could think. Often I use the tree analogy. When's the best time to plant a tree? Well, 20 years ago is the answer. But the next best time, of course, is today. Today's the next best time. So if we can think long range about planting trees, if I can continue with that analogy, in our lives, again, not just to proof ourselves better against the next recession, but what about for our children? What about for grandchildren? And so on. So I would point out that the key to implementing a practice that's going to embody this long-range thinking mentality is to use those depreciating dollars that we were just talking about a moment ago, putting those into guaranteed appreciating assets, which are going to be properly structured whole life policies with mutual companies that pay a dividend. A properly structured whole life policy that pays dividends with a mutual company that's been structured for the banking purpose is going to allow you to deposit. It's going to allow you to pay premiums to own this private asset, appreciating, guaranteed asset with those depreciating dollars and have all the benefits of the appreciating characteristics of a growing death benefit, growing cash values from day one, immediately. The next principle is going to be not being afraid to capitalize. So having a proactive approach to, again, preparing right now for that long-range plan of we know recessions are coming. We're already in one, but even if you're in one, when's the best time to prepare for one? Right now, of course. So don't be afraid to capitalize. Now that's going to look a little bit different for everyone. We all have a different come from. We all have a different starting point. Sure, in the game where we're at now, we are 7 years into practicing becoming your own banker. We have 6 policies. So the multiple policies in a system, with multiple companies that we use for financing our lifestyle such as it is right now. And of course, what we do with those policies and whether we add policies, we will, God willing, to our system into the future is all going to set us up all the better. Again, not just for ourselves. We have 3 children. We have business. We have larger family. We have our extended family, of course. So we cannot hesitate to capitalize our own system. It's something that we should be proactively doing to prepare ourselves now and into the future for what we know is going to happen. In this case, recessions. And of course, there's nothing wrong with walking that out and discussing, well, beyond recessions, will there be opportunities in the future if we proactively amass capital where we can access it? Yes, there will be. Will there be emergencies that may come up that are not recessions, but they are a medical emergency, or there's some sort of natural disaster locally, whatever the case may be? Will it behoove us to capitalize a system that we own and control now for either the eventual or the opportunity? Yes. The answer is yes. Nash's third principle is don't do business with banks. Again, we've already discussed the bank's role quickly, furtively, surreptitiously. We've discussed how banks are contributing to the issue at hand. They are lending out multiples of the dollars that we deposit. Money that doesn't exist. It's compounding the problem. And really, when you think about that. Okay, we're in the rabbit hole. So when banks loan out money that didn't exist prior to us just signing personal loan, car loan, mortgage, whatever, they don't have that money in the bank. They don't have that in the vault sitting still to be collateral for that. It was just created. When banks loan out money, repayments are made back to the banks monthly, of course, principal with interest, really loaded on the interest, especially at the front. They're going to collect the interest before they collect the principal. Anyway, and that in and of itself is a compounding perpetual interest that is paid back to the banks. But here's the point I'm trying to get to here now in this moment is that the money that's paid back to the banks That's real money. From our jobs, from our careers, from our businesses, from our cash flows, we pay the banks back real money. As real as it can be. And again, knowing what banks do with deposits, well, now because they have more deposits being made, they loan out more money that doesn't exist. So they just keep loaning out more and more and more money that doesn't exist. And we are paying back with real money, real dollars. Meanwhile, the government's printing the money, etc. Okay, here we are. It's an interesting thing. It's wild. Again, but I'm trying to focus on the things that we can address. We can think long range. We can capitalize a system that we own and control. We can decide not to do business with banks. We can become our own banker. I strongly encourage the idea that you can become your own banker. Learn these concepts, read these books, listen to this material. Let's have a conversation, study this out for yourself, vet this idea, and then, well, be about it. Don't look left, don't look right. When you know enough to know that you want to become your own banker, be about it. Get to it. Now, in not doing business with banks, there are some other things that we can discuss that are under that umbrella, such as we can then begin to compound deposits. When I say deposits, I'm talking about premiums paid into policies that we own and control. Our deposits can then be compounding uninterrupted in our privatized banking system. That's not to be, what if you were able to compound your income, your cash flows for the rest of your life without interrupting it? That's powerful. Walk that out. Again, thinking long range. Step one. What does that look like when your people receive a tax-free windfall via a death benefit? And if they implemented that same capitalization, talk about a self-sustaining system that generation to generation just passes on bigger and larger and growing and compounding amounts of tax-free dollars. Incredible. You're also able to leverage. So the idea behind owning a properly structured policy with a mutual company that pays a dividend is that you can leverage that policy to access capital. So because you pay premiums and that premium guarantees a death benefit and also it guarantees a cash value, you get to leverage that policy that has that death benefit, that cash value. You get to leverage that via policy loans to acquire capital for your use, your discretion, whatever it is that you're wanting to use that for. You get to leverage your policy to access capital in a known tax environment for whatever it is that you're going to do. So that is a perfectly collateralized. See, with a bank, we're talking about don't do business with banks. With a bank, the car loan, the car is the collateral. You stop making the payments, they can come get the car. Home, you stop making mortgage payments, then come get the home. See, do you own it while there's a mortgage on it? And I'm not necessarily saying one way or another, but I am asking you to think about that. Okay? So this entity is a perfectly collateralized entity because the same entity that provides the access to capital at your discretion also provides its own collateral. Beautiful. So you're able to leverage privately. And let me emphasize that word private. This is a private asset. You can transfer it. So many different things. Now, you can access capital also in a tax-free manner. Policy loans are tax-free. That can't be understated. Taxes are perhaps the largest eroder to wealth, so that can't be understated. Also, by being a part owner of this mutual company, by not doing banks and by funneling deposits, premiums, into a privatized banking system, you get to participate in the overall performance of these companies via dividends. So many different things, so many benefits to us just seceding from the conventional banking system. Now, the fourth is to be an honest banker. Nash would say, don't steal the peas. If you don't understand that reference, again, I encourage you to read his book, Becoming Your Own Banker, where he's discussing the grocery store scenario. See, in a grocery store, you could be both the owner and the consumer. And if you are, don't steal the peas. If you were to take a conventional loan from a bank, that would be a structured repayment with interest, again, on their terms and conditions. So the idea here is you're the banker. You can decide when, if, how you're going to pay back a policy loan. But even the best business can be run in the ground. So be an honest banker. Who are you stealing those peas from if you're walking out the back door of the grocery store? Yourself. It's your grocery store. Don't steal the peas. Be an honest banker. So that's his fourth principle, is to be an honest banker. Don't steal the peas. If you do access capital, pay that back. Pay it back with interest. Now, again, you don't have to, but should you? Yes. The interest that you decide to charge yourself, again, that can just be more capital into your system. You get to control the terms. Again, we've already talked about the collateral. The policy itself is the collateral. So again, just remember, all of this also is going to be you in comparison to the average American. And if the average American is spending 34.5 cents of every dollar on interest, and you're even beginning to, let's say you've recently started this idea and you have one policy and you're starting this, if you even begin to recapture a fraction of that, that's going to exponentially increase your profitability. So by not doing business with banks and by being an honest banker with yourself, the interest dollars that had been leaving your hands going to the conventional banking system, the car people, the house people, whoever, doesn't matter. If you can begin to recapture that back into a privatized banking system, you're just going to become more and more profitable. And of course, over the course of time, income should eventually be the same amount of premiums that you're paying, meaning that premiums become the same amount of income or cash flows that you experience. And you're an honest banker in all that you're doing. In paying your premiums, accessing your capital for the things that you're going to finance, recapturing that back into your privatized banking system, being an honest banker. And again, in comparison to the average American, you're going to win by default. Just by being an honest banker. You're just going to win by default. And you can start right where you are. See, when I started, I had a car note, student loans. Of course, we probably still had doctor bills because our second son had just been born. That same year, we wanted to take a family vacation, credit cards. So we had all these different things. And Nash has the best example right in his book. He had $500,000 in a real estate deal that had a 23.5% interest. Almost 24% interest on $500,000. That's like $75,000 or so a year in interest alone. So he found himself in not an enviable position. And that was where a big part of the infinite banking concept was conceived, is that dire circumstance that he was in. But again, by being an honest banker with his capital, you can just read and see how he extricated himself from that situation. And I found that to be my experience as well. Over the past 7 years of implementing these concepts, we've paid off credit cards, we've paid off the car, we've financed family vacations, paid off student loans, have no student loans, etc. So I can't say enough about being an honest banker. It's Nash's fourth principle. I encourage you to read that in his book for sure. Now Nash's fifth principle is to rethink your thinking. This is one that he added later on in years, it seems, but it's so valuable. It makes me think of when he would talk about the arrival syndrome, of course, and I know that I've decided to be a perpetual student in my life. I actually counted, I can say this right now off the top of my head, and they weren't all about privatized banking, but I've read 15 books so far this year. I said that out loud yesterday because I was curious. That's the only reason I know it right now. I'm not trying to boast or brag, but I've decided to be a perpetual student. I've already talked about the recommended reading in Nash's works. He was obviously a prolific reader. I've decided to be a perpetual student. I want to question my own thinking. I want to question everything out and around me. I want to rethink my thinking. I always want to stay green. There's that saying of if you are green, you're growing. If you're ripe, you're rotten, like an apple. So being able to rethink your thinking. See, me, much like you, if you're vetting this idea for the first time, or even if you're already a client, you have policies, you're implementing this concept, we still have layers and layers and layers of indoctrination and propaganda and influence from home and government schools, etc., that we carry around with us, that we constantly have to vet and implement and apply these concepts. I can just say that even when I had my first policy, maybe my second policy, and my wife and I had already been, financing things in our lives, I still would find myself having aha moments about owning and operating and using our policies. And the more I reread Nash's work, which I highly encourage rereading. Again, we're talking about rethinking your thinking. 7 years later, I'm rereading Nash's books, and I'm still getting new information and new things are settling in. But so much is caught on by actually implementing this concept as well. So I commend you. You're here listening, of course, to the podcast, to the channel, and you're learning and you are improving your abilities and skills and your knowledge base. So I commend you in that. And what I would like to say is, in addressing this concept of recession-proofing ourselves, we're in one right now. Right now, we're in a recession. August 2022. We've been in others. In my lifetime, my wife and I, we've been in others. Some before we had even known about this idea of becoming your own banker. What we see is that they have happened. They're happening right now, and they're probably going to continue to happen. But when we bring banking back to the me and the you level, it completely changes the environment that we're operating in. Remember what Nash would talk about, the airplane in his Becoming Your Own Banker book. A plane doesn't fly through a vacuum. Yes, you could work on improving the plane, of course. But if you could control the environment around a plane, it'll blow past the others. If everybody else is dealing with a headwind and you've got a perpetual tailwind, you'll win by default. There's no question. So that's what I'm trying to promote, is the idea that you can control your environment to the extent that you can. You can control your environment by thinking long range, not being afraid to capitalize. Don't do business with banks. Be an honest banker yourself and rethink your thinking. You're doing that. I commend you in that. So if you're vetting this idea, if you're already a client and you'd like to have further discussion about this subject of recessions, what it is that you are doing, don't hesitate to reach out. You can have a free consultation, 828-817-4223, or you can email durhamtalents@gmail.com. This has been a great pleasure for me. I do look forward to our next conversation. Have a great day. Take care. Hello and welcome to the Durham Talents channel. Let's do that again. 5, 4, 3, 2. Wingardium Leviosa. It's Wingardium Leviosa, not Leviosa. It's enough of that. Now, we're going to do that again. For today's topic of discussion, we're going to be extended. My name is Antonio Banderas. I am Puss in Boots. Hello, kitty kitty. Smeagol. I had a little bit too much. A little bit too much.
Smeagol. Why does he cry, precious? False, tricksy Harrises. They stole it from us.
think I'm getting there.
My own. My precious. What's Teacher's precious?
I think that was pretty good.
You keep nasty chips. Give it Trish. Raw. Rickling.
All right, that's the. Gonna have to stop that one there.